Alright, so in this lecture, this video lecture, we're going to cover the second half of Lesson 14 on the Federal Reserve and monetary policy. So in the note sheet I'd posted previously, just kind of goes over the history of what led up to the creation of the Federal Reserve. Talks about their dual mandate to try to achieve full employment and maintain price stability. And then it discussed just the three major parts of the Federal Reserve System: the Board of Governors, the regional banks, and the Federal Open Markets Committee. Now, before we get into the tools of monetary policy, there's just two things I want us to keep in mind. The first is the money supply. And we're just going to think about, for now, just that M1 measure the money supply. So that includes the currency in circulation and checkable deposits, and then any traveler's checks that are outstanding. So we want to keep in mind of what is included in the money supply and what isn't. And in particular, recall that we said vault cash is not included in the money supply. So when I have currency in my pocket, I walk into the bank and I deposit it. They will add $20 to my checkable deposits, but then we've just taken that $20 out of circulation, and that $20 bill, that physical bill, gets put in the vault. It becomes vault cash, and it effectively disappears from the money supply. So that's going to be one thing to keep in mind. Now, the other thing to keep in mind is that what happens to that vault cash once it hits the vault. Well, remember that when a bank accepts money from a customer, they have to meet that required reserve ratio, which says for every dollar they accept, they have to keep some in a safe place. That's what's going to be called their required reserves, and then everything else becomes excess reserves. And it's these excess reserves that banks are going to use to do things like making loans, right? Because a bank is a firm. Firms want to make profits. How does a bank make profit? They take the dollars in their bank and they loan it out to people and they charge them interest. So this idea of money entering and exiting the money supply, of banks utilizing their excess reserves to make these loans, this is going to be key to monetary policy, because every time a bank takes a dollar out of the vault and loans it to somebody, they are creating money. Okay, so the money supply is going to increase when banks are able to make more loans, and when banks, for some reason, are able to make fewer loans, then we're going to see the money supply actually contract. And so this is going to be the key to monetary policy. Now, the three tools of monetary policy. We've already mentioned one of them, and that is the required reserve ratio, which simply says to a bank, what percentage of deposits must you keep on reserve. So for example, I think for a lot of banks these days it's around 3%. So for every dollar they accept, they put 3 pennies over here in required reserves, and then the other 97 pennies become excess reserves. Now, if we were the Federal Reserve and we were to raise or lower that required reserve ratio, well, if we raised it, right, if we raise the required reserve ratio, that tells banks that you have to keep more of your customers' money safe, right, in those required reserves, which means there would be less money left over in excess reserves. And remember, those excess reserves are what banks use to make loans. On the other hand, if we were to lower the required reserve ratio, that means that we're telling banks you don't have to keep as much money or as much of your customers' deposits in required reserves, which means they'd have more money left over in their excess reserves, and this could make more loans. So that's our first tool of monetary policy, the required reserve ratio. The second tool is one we've also kind of mentioned. It's these open market operations. And so these, of course, are conducted by the Federal Open Markets Committee. And in other words, this just means that the Federal Reserve is buying and selling bonds from private banks or private businesses or private entities. Okay? And remember, a bond is simply an IOU. It's a form of debt issued by the federal government. So remember, the federal government can go and borrow money from the Fed, but the federal government can also go and borrow money from American households, American businesses, and American banks. And once the federal government borrows those dollars and it issues the bond to the person that's loaning them the money, that bond can be bought and sold on the open market for bonds. And so the Federal Reserve is going to participate in that open market for bonds, just like any other actor might. And so, for example, if the Federal Reserve decides, you know what, we want to sell some bonds. Maybe the Federal Reserve already had a bunch of bonds and they want to sell them to private banks. Well, how is that going to affect the private banks? Well, if I'm the Fed and you guys are private banks and I sell you bonds, that means I give you the bonds, and what do you give me in exchange? Well, you're going to give me money, because in this sense, you, the private banks, are buying the bonds. Where are you going to get that money? You're going to take it out of your excess reserves. So when the Federal Reserve sells bonds to private banks, banks will see a decrease in their excess reserves. And alternatively, if I'm the Fed and you guys are the private banks and I say, hey, you guys have some bonds, I would like to come and buy them from you. Well, you'll hand over the bonds to me and I will hand over cash, and that cash will go right back into your excess reserves. So when the Federal Reserve buys bonds from private banks will have more excess reserves. Now, the final tool of monetary policy is what we call the discount rate. And this is simply the interest that the Federal Reserve will charge to a private bank when that private bank comes and borrows money from the Fed. So recall in our discussion of the regional banks, one of their functions is that they serve as the lender of last resort. So when private banks get into trouble, they can go to their bank, the Federal Reserve, and borrow money. And when they do that, the Federal Reserve will charge them interest, and we call that the discount rate. Now, if we were to raise the discount rate, that means the private banks would probably borrow less money from the Fed, which means there'd be less money in their excess reserves at the end of the day. So their ability to make loans would be lessened. And alternatively, if we were to lower the discount rate, then that means banks might be willing to borrow more from the Fed, which would translate into more money in their excess reserves, and that would increase their ability to make loans. So those are the three tools: required reserve ratio, open market operations, and discount rate. And with each of these tools, it either goes one way or the other. So it's kind of like fiscal policy, right? With government spending and taxation, we can spend more, spend less, tax less. That's how we carried out fiscal policy. And now what we're saying is we've got a different set of tools, a monetary policy toolbox. And again, we're just going to select one of those tools and either raise it or lower it, buy or sell bonds, and this is how we're going to conduct monetary policy. Now remember, with fiscal policy, there were basically two types. And which type of policy we conducted depended on which problem were we trying to address. And it boils down to unemployment and inflation. So for example, if we determine that unemployment is on the rise and we're the Federal Reserve, then again, part of our dual mandate is to maintain full employment, and so we would choose to enact what we call expansionary monetary policy. So it's kind of like expansionary fiscal policy, where we spent more, taxed less, but now we're using a different set of tools. And so I've got a little chart that's posted, and you can refer to that. And I've got the tools listed, and then I've got the columns showing expansionary, contractionary policy, showing how we would use each of these tools. So with expansionary policy, to address a recession, to address unemployment, we would do one of three things, or some combination. If you're looking at the chart, we would buy bonds, we would lower the required reserve ratio, or we could lower the discount rate. All right, so any one or any combination of those three actions would be expansionary monetary policy. And then the question is, well, what is that going to do for the economy, right? How does changing one of these tools actually help address unemployment? Well, remember that when we make changes to our monetary policy tools, it's going to affect the amount of money that banks have in their excess reserves. So if we buy bonds, lower the required reserve ratio, or lower the discount rate, recall that we said that would lead to more money in banks' excess reserves. Well, what do banks do when they have more leftover money? They're going to take those dollars out of the vault and they're going to start loaning them to American households and firms and businesses. Right? Well, what's happening when a bank makes a loan? Remember, they're taking dollars out of the vault and they're putting it in someone's pocket. Well, what they've just done is, in a sense, they've created money. In other words, the money supply has increased. We've grown or expanded the money supply. All right, we took dollars that were in the vault that weren't included and we put them into circulation. Well, again, how is this going to put people back to work? Well, remember, when people have more money, they are likely going to spend it. And if banks are making more loans, that means they're getting more money out to circulation. That's going to turn into more spending, right? People have more dollars, they will spend more dollars. The other way to think about this is from the supply and demand perspective. So remember, there are people that are demanding loanable funds and people that are supplying loanable funds, borrowers and savers. Well, if banks have more money to supply to borrowers, right, what that's going to mean is that there will be an increase in the supply of dollars. And remember from our microeconomic fundamentals, anytime the supply of something increases, what happens? Well, its price is going to decrease. Well, what's the price of money in this case, right? What's the price to borrow money? What's the price you pay? Well, it's the interest rate. And so what we're going to see is that as a result of the Federal Reserve's expansionary monetary policy, It's going to boost excess reserves in the private banks. Those banks will make more loans with a greater supply of loanable funds. That's going to drive interest rates down. And remember from our discussion of investment spending, but also from consumption, if interest rates are lower, people are probably going to borrow more money and then spend more money. So when interest rates are low, people will borrow a little bit more and buy that new car, or they'll buy that house, or they'll open up a new credit card with a lower interest rate, and then they'll start spending money. And eventually, as people spend more, we're going to see that aggregate demand is going to increase, which means economic growth, right? Output's going to increase. And as we know, when output increases, unemployment decreases. Okay? So the end result is the same as it was in fiscal policy. With expansionary policy, whether it's fiscal or monetary, we're going to see an increase in aggregate demand and thus an increase in output, a decrease in unemployment. But remember, from our model, when aggregate demand rises, the downside is we get higher prices, inflation. So that's expansionary monetary policy. Now, on the other hand, what if inflation is becoming a problem? What if the economy is doing just fine in terms of output and employment, but prices are starting to rise? Well, just like fiscal policymakers, monetary policymakers will decide to conduct contractionary monetary policy. And if we look at the chart, I've got it summarized real quickly here. The Federal Reserve could choose to sell bonds, or it could raise the required reserve ratio, or it could raise the discount rate. And if it does any one or any combination of these three things, what's going to happen is that private banks, recall, they're going to have less money left over in their vaults at the end of the day, right? They will have fewer excess reserves. And if banks have fewer excess reserves, that means they don't have as many dollars to then loan out. So the supply of loanable funds decreases. And what that does, again, when supply decreases, you get an increase in the price. So in this case, when banks aren't able to make as many loans, the price of a loan will be a higher interest rate. And of course, when interest rates are higher, people don't borrow as much, right? So maybe they were going to buy that car, but then the interest rate for a car loan went up, and so they hold off, right? So they don't take out that loan, they don't buy the car, they don't buy the house, they don't open the new credit card. And so as a result of this contraction in the money supply, this contraction in excess reserves that leads to an increase in interest rates, is we're going to see a decrease in aggregate demand, right? It costs more to borrow, so people won't want to spend as much. Aggregate demand decreases. And then, of course, remember our model will predict that this will solve, the inflation, or reverse it. Okay, so the price level will come back down. But of course, given a ratchet effect, the best we can hope for is that prices just won't continue to go up. So prices were going up, we're going to kind of, say time out and put a cap on them. And of course, the downside to this is even if we get prices under control, a decrease in aggregate demand leads to lower output and, of course, higher unemployment. So that's monetary policy. And again, we've got three tools: required reserve ratio, open market operations, discount rate. And then we're going to use those tools in one of two ways: to either conduct expansionary monetary policy to address unemployment, to try and boost spending, boost demand, or we would employ those tools in a way that represents contractionary monetary policy in an effort to get prices under control, which would then decrease aggregate demand. Now, there's a few other considerations we need to talk about. So just like with fiscal policy, we are going to face some policy lags. And remember, lag is just something, it's a delay, it's something that slows you down. So the three lags we discussed were recognition, decision-making, and execution or implementation. So again, first you just have to, it may take you some time to realize that you actually have a problem, that unemployment or prices are getting out of hand. So monetary policies, just like fiscal policymakers, are going to be watching the data, but even for monetary policymakers, it'll take some time before we finally say, okay, yep, we're in a recession. Okay. Now the next lag, of course, is the decision making. So with fiscal policymakers, members of Congress, the president, this is where they may tend to get bogged down a little bit, because again, in Congress with the president, there's going to be party politics, there's going to be divisions and debates, and so it may take a bit longer for members of Congress and the president to actually make a decision, regardless of whether it's expansionary or contractionary policy. Monetary policymakers, on the other hand, they're still going to face this decision-making lag. They can't just snap their fingers and make a decision overnight once they realize there's a problem. But the good news is that the Federal Open Markets Committee, in particular, meets very regularly, about every 6 to 8 weeks, 8 times a year. And at the end of every meeting, they meet for 2 days, and at the end of that second day, they vote. And what are they voting on? Well, remember, the Federal Open Markets Committee is in charge of the open market operations. So this means that 8 times a year, that FOMC is going to be meeting and deciding whether they're going to buy bonds or sell bonds or do nothing. If they were already buying bonds, maybe they'll buy more, maybe they'll buy less. If they were already selling, maybe they'll buy, sell less, sell more. Okay, but at the end of every meeting, they make a decision. Well, in the meantime, Congress may be still, going through their debate process. So there's another advantage here, though, in that, members of Congress, one reason why they disagree so much is because, every member of Congress has to make sure that they're representing their voters back home. They're worried about elections and politics. Well, remember that the Federal Reserve is kind of set aside from politics. So the Board of Governors, right, they're appointed by the President, they're approved by the Senate, but once they're approved, once they're on the job, they're kind of insulated from politics. And so they may have, disagreements. There may be debates within the Board of Governors or within the FOMC. But again, at the end of the day, they don't have to worry about, running for re-election like members of Congress. And at the end of the day, they have to make a decision at the end of every, FOMC meeting. And so this decision-making lag will, on average, be probably a little bit shorter than it would be on the fiscal policy side. And then finally, just like fiscal policy, we're going to face that execution lag. Again, we can't just snap our fingers and make something happen. Whatever decision the FOMC makes, or whatever other changes the Board of Governors makes, it takes time to actually put that plan into action and see the fruition of your policy. So that's monetary policy in kind of a nutshell. Again, we've got our 3 tools: open market operations, required reserve ratio, discount rate. We know what we can do to each one of those tools, and depending on how we manipulate those tools, the result will be or will represent either expansionary policy or contractionary policy to fight either unemployment or inflation. This is going to be transmitted to the economy through a change in banks' excess reserves, which means they're going to make more loans or less loans, so the money supply is either going to grow or contract. This is going to lead to a change in interest rates, and eventually then, after the change in interest rates kicks in, we'll see people borrowing more, spending more, or borrowing less and spending less. And then from there on out, it looks again the same as it did for fiscal policy in our ADAS model. We'll either get an increase in aggregate demand as a result of expansionary monetary policy, or we'll get a decrease in aggregate demand as a result of that contractionary monetary policy.